Good morning and welcome. Thank you for taking the time to join us for our Canadian Bank webinar as part of our 2022 Credit Outlook series from the team at DBRS Morningstar. My name is Patrick Miller. I am a member of the DBRS Morningstar Business Development team and will be your moderator for today's discussion. Our Canadian Bank analytical team member, Carl de Souza, will be referencing the recently published commentary titled Large Canadian Banks, Cautious Optimism Heading into 2022. The Canadian banking outlook for 2022 remains cautiously optimistic despite persistent uncertainties related to the coronavirus pandemic. Inflation and related supply chain bottlenecks, rising interest rates, and wage growth pressures, strong credit quality, and improved macro environment outlook and government support programs help propel the Big Six to strong performance and an improved year-over-year returns on equity in fiscal 2021. Despite net interest rate pressures from low interest rates, the bank's highly diversified franchise allowed them to capitalize on elevated trading and client activity in their capital markets business in the first half of fiscal 21. DBRS Morningstar does not expect the level of provisions for credit losses, reversals, or heightened capital markets activity recorded in the first half of fiscal 21 to be repeated in 2022. We would like to note that our analytical team tends to use the large Canadian banks as a proxy for the banking sector, but we should clarify that the discussion does broadly apply to all the Canadian banks in our rating universe. Following the conclusion of the discussion, we will have time for questions, so please submit any Canadian bank-related questions, even if they fall outside of the material discussed. Please submit questions via the Q&A box on your Bright Talk screen as they arise during the presentation. Without further ado, I would like to turn it over to my colleague Carl, who will take a few moments to introduce himself before we begin our discussion. Thank you.
Thanks, Patrick. As Patrick noted, I'm Carl de Souza. I am a Senior Vice President with the banking team as part of the North American FIG, or Financial Institutions Group, here in Toronto and Canada. And I've been with DBRS Morningstar since September of 2021. Prior to that, I was with OSFI, the Federal Banking and Insurance Regulator, for nearly 9 years and worked in their credit risk division as well as on their supervision team supervising large banks. And prior to OSFI, I was nearly 14 years working with 3 of Canada's large banks in various credit-related roles.
Wonderful. Thanks, Carl. So why don't we start the conversation off with an overview of the recent performance of the large Canadian banks?
Sure. Thanks, Patrick. Before getting into the 2022 outlook, let's first take a step back and look at fiscal 2021. After the onset of the pandemic, material provisions for performing loans were taken by the banks in fiscal 2020 to account for anticipated credit quality issues resulting from the pandemic. Credit quality issues, however, never materialized as initially anticipated, and performance was aided by government support programs. As a result, and what we saw through fiscal 2021 was that provisions for credit losses reversals boosted earnings, along with elevated capital markets activity in the first half of 2021. The banks ended up producing strong asset quality metrics, ample liquidity, and robust capital levels. The chart on your screen shows the return on average equity for the Big Six banks and then an average, and it reflects the improved performance in fiscal 2021 with an increase to 15.2% from 11.5% in the prior year.
Great, thanks, Carl. How does the team view the shifting landscape for drivers of profitability moving into fiscal 2022?
Sure. As Patrick noted in his introductory comments, we expect the drivers of profitability in fiscal 2022 to shift. The macroeconomic story heading into 2022 is inflation, which is at a 30-year high. Additional uncertainties also include COVID and related supply chain bottlenecks, the magnitude and the pace of rising interest rates, as well as wage growth pressures. If interest rate increases are more modest and gradual, it should benefit the banks and their asset-sensitive balance sheets. The bank's assets tend to reprice higher faster than the liabilities do. While residential mortgage lending volumes have been strong, non-residential mortgage lending volumes remain well below pre-pandemic levels. Expected growth in higher margin non-RESL or real estate secured lending loan volumes and higher interest rates should bolster net interest income and earnings. This should help more than offset an expected modest deterioration in asset quality metrics resulting from two things. One, higher loan volumes, which would usually naturally translate into slightly higher or deteriorating credit quality metrics, and then asset quality metrics that are at unsustainably low levels. If you look at the chart on your screen again, you'll see two prominent credit quality metrics in the form of provisions and gross impaired loans. And you'll see the trending there, which isn't really a surprise. You will note that in Q2 2020, after the onset of the pandemic, you'll see the spike there in provisions as many of the banks took elevated provision charges in Q2 and Q3. And since that, they've been trending downward. And as I noted earlier on, you'll see in Q3 2021 and Q4 2021, they were actually negative trends, which indicates that on an aggregate basis, there were PCL, as we like to call them, or provision for credit loss reversals. On the impairment side, not as drastic, but you'll also notice, they started to peak in Q2 and Q3 of 2020 and have been trending downward since. So the credit and asset quality metrics across the banks are really good, going into the fiscal 2022 year. Larger and faster interest rate increases that negatively impact economic growth, however, may lead to increased credit quality concerns and potential credit losses from higher debt servicing costs, offsetting the benefit of higher net interest margins and loan volumes. So initially, with the onset of higher interest rate increases, banks, as I've mentioned, having asset-sensitive balance sheets, it should be a positive, but it depends on the magnitude and how quickly interest rates increase, because at some point in time, it may impact credit quality, and credit losses can, as I just noted, somewhat offset the benefit from the higher net interest margins.
Interesting. Well, I guess certainly central banks will continue to be an important focus for the banking sector over 2022. As that leads in, we can't have a discussion on large Canadian banks without taking a few moments to discuss the current landscape in the Canadian housing market and the concern around elevated debt levels.
For sure. The housing market in Canada is always a hot topic. It's been a hot topic for a long while. It was one of the biggest concerns when I started at OSFI in 2012, and it was the biggest concern when I left OSFI in 2021. So it's been around for a little while. It's talked about a lot in the media. So I'm just going to provide you with a bit of an overview as to how we see it. Basically, supply-demand imbalances continue to drive house price appreciation, and this is not expected to change in the near term. Supply challenges have been well documented, and we're at an all-time low in months of national inventory in December. And additionally, demand continues to be intensified by investors and record levels of immigration. As we've seen, when we get the immigration, people look for housing. So, you still have the demand pressures and shortage of supply. So that leads to price escalation. And so the near to medium term, we don't really see, a material impact on prices due to those factors. I think the chart on household debt and household prices is very telling. So Patrick, if you scroll back, yep, that one there. Nope, that one, yep. It illustrates the material increase in prices since the onset of the pandemic. If you look at the blue line, you'll note that the MLS home price index increased 26.6% year over year, which is a very, very material increase. As well, you'll see on the red line, household debt levels remain very high and have resumed an upward trend. The chart there shows a downward trend after the onset of the pandemic as non-residential loan balances were paid down. So people took the opportunity with being able to save more to pay down some of those non-residential loans. And however, with the housing market heating up as the pandemic, got into a few months of having the pandemic, you'll see from the last few quarters, the household debt levels have been trending quite high and upward. The next chart shows a more recent trend with over 50% of new mortgage originations coming from variable rate mortgages since July. This is driven by the increased spread between the variable rate and fixed rate mortgages. Usually somewhere around 75 basis points to 100 basis points can cause people to look a little harder at variable rate. The interesting thing that this chart shows is that you can see the historical numbers dating back to December 2019. It's always been more fixed rate mortgages. The most popular term in Canada is a 5-year fixed rate term. And you can see that in the chart is going back to December 2019, there wasn't much variable rate mortgages as a percentage of the overall new originations. However, you see the trend completely change, midway through 2021. And now the variable rate mortgages represent about 27% of outstanding mortgages. The trend is somewhat concerning, considering the elevated household debt levels and housing market imbalances just discussed. There are some mitigants, however. One of them is variable rate payments. So this has been talked about quite a bit. However, variable rate payments are usually a fixed payment. So in the situation where you're in an increasing interest rate environment, what happens is your payment will usually stay the same, but a higher proportion of that payment will go towards interest payment and a lower proportion, obviously, towards your debt repayment. So interest rates would have to materially increase to cause your fixed variable rate payment to increase. And so the other mitigant is also OSFI, and they in 2018 put in a minimum qualifying rate, or MQR, that factors into a stress test on new originations. So what that essentially means is that when borrowers go in for a new mortgage, they negotiate a contract rate. Those contract rates are extremely low right now. Even though fixed rates have increased a little bit, they're still very, very low compared to historical rates. And the minimum qualifying rate that OSFI has implemented requires banks on uninsured mortgages to stress test that borrower at a minimum floor of 5.25%. In the situation where interest rates start to increase, it's your contract rate plus 2%. But that contract rate plus 2% right now is well below the 5.25. So the borrowers, when they're being qualified, will be stressed at 5.25. And that provides a very nice buffer over the existing rates and provides room for interest rate increases. Highly leveraged investors, however, are more of a concern, particularly when interest rate increases start to materially impact the profitability of their investment and cause them to sell. We've seen numbers in where investors now represent about 20%. So it's not an immaterial number. And if investors decided that the profitability metrics didn't work for them and they decide to start selling en masse, that would add a lot of supply into the market, which is not a good thing. Another not so recent but concerning trend is related to the popularity in combined loan plan mortgages. This product is essentially a combined mortgage and HELOC, or home equity line of credit loan plan, that has both revolving and amortizing features. OSFI superintendent has recently expressed concern with these HELOC and HELOC-related products, as they make it more difficult to assess the credit risk due to the readvanceable nature of the products. The use of the HELOCs and non-traditional housing-backed products effectively turn a traditionally amortizing product into a revolving or readvanceable product. This can lead to higher outstanding principal balances, increasing the risk of loss to lenders. Additionally, when you see things to monitor the credit quality of a mortgage portfolio, such as loan to value, it doesn't take into account the readvanceable nature of a HELOC, because its existing balances are average balances. And in times of stress, what not only companies but individuals will draw down on their lines as they get into financial stress. So if that happened with these readvanceable products, your loan to value would suddenly increase again, without call, because you have the ability to draw down on them. You're in financial distress, and you will, history has shown that you would draw down on them. The other important issue is that borrowers can also disguise financial distress by drawing on their lines of credit to make mortgage payments, effectively taking from Peter to pay Paul. And so those factors make it hard to really assess credit quality, and these combined loan plans are extremely popular products right now. So a lot of the new mortgage originations go into these products. With a series of interest rate hikes expected in 2022, demand has also been brought forward and resulted in an abnormally hot winter market. it's expected that mortgage lending volumes should somewhat temper in the second half of 22 after the spring market, which is usually traditionally a hot market.
Well, thank you for those comments on the housing landscape. The commentary also touches on two additional risks to consider in the future: climate risk and digitization. Can you expand on those topics a little further?
Sure, Patrick. These are two items that have been making more headway in the news lately. Climate risk is a topic that's not only getting heavy focus in the media and with investors, but it's also gaining increasing focus from regulators. The Bank of Canada, OSFI, and 6 financial institutions develop climate scenarios to help identify, measure, and disclose climate-related risks. The scenarios focused on transition risks rather than physical risks, and indicated this transition will be more challenging for countries like Canada that have carbon-intensive sectors. While it's still somewhat early days and not expected in 2022, OSFI is already considering increasing capital buffers to protect against risk from climate change. So as an example, the large banks, they have several tiers of capital thresholds that are imposed by the regulator. And this would add on to one of those tiers if they decided to increase the capital buffer. With respect to digitization, the pandemic has accelerated digital transformation. Customer expectations around digital banking experience have increased, with fintechs expanding personalized services and what is possible through things like AI, artificial intelligence, and blockchain. While banks are prioritizing their digital strategies, it is important that there is engagement with risk and compliance teams to put the necessary controls in place. A key concern in 2022 is the aggressive competition for talent. Banks are looking for the same required skill sets, such as math, coding, other technology-related skill sets, and there's a shortage of talent available. So what that means is it's a challenge for the banks to obtain the talent that they are looking for, because they're all looking for it to enable their digitization strategies, as well as likely to increase labor and wage costs for that talent.
Interesting comment of how even the labor challenges are touching on seemingly every industry out there. Let's just finish off with taking a look at the large Canadian banks' capital levels and potential for allocation of excess capital into 2022 and beyond.
Yeah, capital is a really interesting one. So at the onset of the pandemic, OSFI implemented capital management activity restrictions that essentially halted dividend increases and share buyback programs. As a result of that, the banks elevated their capital because they were not able to use their capital as effectively as they would in normal times due to those restrictions. OSFI recently lifted those capital management activity restrictions in November of 2021. And since that time, you've seen several announcements. As an example, with their Q4 2021 results, the banks all announced dividend increases, and they all announced the intent of share buyback programs subject to approval by the regulator. And that obviously was expected, considering the elevated capital levels that they have right now. So the chart on your screen just shows exactly that. It'll show you the levels for the big six individually where they're at, with TD the most elevated right now, and the average of the big six at 13.3%. As a comparison, that 13.3% in Q4 2022 was 11.6% in Q1 2020, just before the pandemic. So you can see even on an average basis how the capital levels have increased. Now, with that announcement from OSFI, obviously the banks have initiated some activities already, and it's expected going into 2022 that the banks move their CET1 ratios or Common Equity Tier 1 ratios closer to the 11 to 12% range, with excess capital used for acquisitions, share buybacks, or a combination of the two. As an example, we've had 2 recent transactions in the Canadian market that have already started on this trend. BMO recently announced a $16.3 billion acquisition of Bank of the West. As a result, they had the intent to do a share buyback program. They've put that on hold right now until the acquisition of Bank of the West closes. And just recently, this week, we saw the announcement of Equitable Bank acquiring Concentra Bank. So this trend is expected to continue, where the banks deploy their capital more effectively, than they were able to when they had the restrictions imposed on them to effectively deploy capital and turn that into an increase in return.
All right. Well, thank you for the insight and your comments related, at a very high level. We're at the end of the prepared remarks for this presentation, and we just want to remind the audience out there that we are open for question and answers. So please, anything that you would like to hear, add them to your question box. As the audience takes some time to get a few questions in, maybe we can start out and back to housing, which we always seem to speak of as what a large driver of our economies and banks' balance sheets. You mentioned the supply shortage, or the supply challenges, I guess maybe is the better word. Immigration always seems to be a talking point there. I don't recall hearing you made any comments on that. Do within our process, do we include sort of analysis on immigration supporting the market, or maybe do you have some thoughts about how that's a positive counter, versus potential increasing interest rates?
Yeah, I think with regards to immigration, Canada has immigration-friendly policies, as we all know. And relative to the United States, an example, with 10 times the population, we have much higher immigration levels, relatively speaking. So with that kind of level, as an example, I think the number was just over 400,000 new immigrants in 2021. And so, which represented the most in a single year. And so our population, I believe, is also the highest growth in the G7, and with a lot of that coming from immigration. So those things help to drive demand, because new immigrants coming into the country are obviously going to look for housing, whether it be rental housing or purchasing housing, right? And so those things support drivers of demand. And then on the supply side, as I mentioned, that's more of a medium to long-term story. It's been talked about a lot about how we can possibly increase supply in the Canadian market. We have all seen the shortages of supply and listings, and again, that drives prices up. So you've got high demand, and you've got pent-up demand still because of the lack of listings, and just not a lot of supply on the market. Definitely not enough to meet, the demand that's out there. And so those things will continue to put pressure on prices. Will they escalate and continue escalating at the same pace? That's hard to say, but I wouldn't expect a decrease in prices of any material magnitude until some of those drivers dissipate a little bit. And, we can eventually bring a little bit more supply online, and also listings increase again. And so that side of it will continue to put those pressures on. And so, I think until I don't see really Canada changing their immigration policies, at least not in the near term. So the one thing that will moderate likely a little bit is that, as I noted, shortly after the onset of the pandemic, the housing market really picked up after a lull and has been accelerating ever since. And, the winter, as I mentioned, is an abnormally slow market. It's really heated right now. So people are obviously well aware that interest rates are going up. It's just a matter of when the Bank of Canada pulls the trigger on that. And I think that in light of that, if they were even thinking of buying, they're bringing that forward, right? So it's even pumping up demand more now in a traditionally slower time for housing purchases. And so again, that leads to my thoughts that we should see somewhat of a moderation in mortgage lending volumes in the second half of 2022, and hopefully an uptick in the non-residential mortgage volumes. because provided the economy continues to chug along, I mean, it might have little dips, as it did in recently with our lockdown, but provided the economy continues to perform and perform somewhat well, people will start spending again. And you'll see though that spending hopefully transition from goods to services. And as that happens, people spend, they add to their credit card balances. As some of those supply chain bottlenecks hopefully dissipate on things like autos and the chip production, and autos come, you'll see an increase in auto loans and things like that. And those are much higher margin businesses for the banks. And so, some of the banks in auto loans participate both in the prime and subprime markets. So the subprime is even higher margin. So that will be of benefit to them. And the Bank of Canada is looking at, fiscal 2022, the drivers being consumer spending, exports, and business investment, right? So provided those things hold up, that's how I kind of envision it, all else being equal, with respect to loans and trending in 2022.
Interesting, and thanks for the insight on the headwinds faced on potential mortgage origination growth, but the opportunities in other areas of the sector as we reopen. We appreciate, we've got some questions that have come in. I'm going to kind of pair two together that are focused on the chart we're looking at right now, CTE ratios. So really the first one, sort of, I guess, a clarification. It says, is the minimum CET from OSFI is 10.5%, or is it total CAR? And forgive me, because I'm not sure what the CAR acronym is. I'm trusting you're probably familiar with that.
Yeah, I think what the person asked the question is alluding to the CAR guideline from OSFI. And so that guideline from OSFI will bake in different thresholds. So the question is that. So the chart, what it's showing you is that red horizontal bar is at 10.5. That's the CET1 threshold. And so that is the highest quality capital. And okay. That is now that threshold of 10.5 has a lot of things baked into it. There are different tiers that aggregate to 10.5. And one that's been in the news lately is the DSB, or the domestic stability buffer. So what happens is OSFI sets the domestic stability buffer. That's the top tier for CET1. So what happens is they lowered it to 1% at the onset of the pandemic from, I believe, 2.25%. And the purpose for that was because they didn't want markets to seize up from a lending perspective at the onset of the pandemic. So OSFI pulled that lever that they have to free up some capital for the banks to use toward loan lending. As I spoke about earlier, that wasn't needed during the pandemic. Mm-hmm. And so through the course of the pandemic, OSFI then increased that domestic stability buffer from 1% back up to 2.5%. So that top tier of the CET1 threshold is the DSB at 2.5. That's part of that 10.5 threshold.
Okay, well, we'll appreciate the sort of overview, technical breakdown on how it's composed. So looking at this chart, there is a question from a participant, noting that TD sticks out with the highest common equity ratio. So this might be a little tricky for you to answer directly, but there's questioning: do you think that positions them for an M&A activity? If you're able to comment on that.
Yeah, I mean, I think I alluded to this earlier. I think, banks are open to acquisition, share buybacks, or a combination. And what I mean by a combination of that is, if you do an acquisition as material as BMO did at 16.3 billion, obviously that and you're utilizing some capital for that, it kind of limits you on the share buyback perspective. If you do some more smaller strategic bolt-on acquisitions, they might not be as material to a bank such as TD. That might still enable them to do a share buyback. I think they recently got authorized for about a $50 million share buyback program. They might not do that then, right? They might purchase less than the 15 million. It's up to their discretion as to how much they purchase. But your observation is correct. They are at the highest CET1 threshold. They have capital, and so I think they would be looking for things to effectively deploy that capital, and an acquisition is one of those things. Now, with big acquisitions, I mean, they don't come up every day, such as Bank of the West, right? So, it could be a smaller acquisition or acquisitions that are a strategic fit.
Okay, well, thank you. So I guess ultimately it gives them the most flexibility to consider options. I do want to come back and thank you to the audience member who clarified the question that we started with around the capital adequacy ratio. And to specify, the question is, what is the OSFI minimum total capital adequacy ratio?
So I think the total off the top of my head, I can look that up and get that for you. Off the top of my head, it's a few percentage points higher. So they have a total tier 1 above the CET1, and then they have a total capital. So I can look that up and get back to you on that. I just don't want to quote it off the top of my head in case I'm not recalling.
Well, no, and that's great. I mean, a part of this is, we always like to remind the audience of your availability to help, address any questions. So I flipped over to the contact information of yourself and your colleague Maria, who handle all the ratings on the large banks. So perhaps that audience member, if you feel comfortable, just reach out to Carl directly via email, and he can clarify.
For sure.
For you.
For sure.
So we do have a few other great questions that have come in that we'll move on to some other topics. And I'll say maybe this one's tricky. I'll blend them into two, as there's questions in terms of what your view might be with bank results. So bank results are expected later this month. So the question is sort of around any expected headwinds that could affect the results. And I appreciate that's a difficult thing for you to comment on, because really our job is the medium-term credit view of the institutions. But maybe within that, we could blend in, and you did mention the potential interest rate increases coming up, but what effect is the potential for the rising interest rate environment to have on the bottom line over fiscal 2022?
Yeah, I think that's a little clearer. We're going to get interest rate increases. The governor just spoke again yesterday, hammering home that they're coming, and the market has baked in a March pretty assured increase. And so there's also about 5 to 6 interest rate increases projected over the next year, which, if you look at 25 basis point increases, if that's where you would think they would be, they could go a little higher, I guess. But if there's 6 interest rate increases of 25 basis points, that would be 1.5%, right? And so with a Bank of Canada overnight rate net right now, that would put it at 1.75%. Right, so it's a decent uptick, and so for Q1, that question, it's a little hard because there's no interest rate increases in Q1. So Q1, at least for large banks, ends in January, obviously, and then there's the smaller banks are more on a calendar quarter. But going forward, those interest rate increases will translate to the bottom line, and you'll see some banks benefit a little more than others. As an example, I think TD, for example, has a very material retail presence and retail loan volumes relative to some of their peers. And so while that, through the low interest rate environment has hampered them a little bit more, they also stand to benefit more from interest rate increases. But all the banks will benefit, through, as I noted earlier, interest rate increases. There's a lot of uncertainties which are really hard to predict. We saw that there was a slowdown, in the economy with the result of Omicron and the restrictions that were imposed. As well, we've seen the Bank of Canada and others downward revise their economic GDP forecasts. There's still growth forecasts for sure. And so I think going forward, it'll be interesting to see where the Q1 results come out. But one thing that I noted earlier, which I can expand on, is while we don't expect to see the same level of PCL reversals in fiscal 2022 that we did in fiscal 2021, because they were material over fiscal 2021, it's interesting to note that the bank's allowance levels are still higher than pre-pandemic levels. So the provisions come out of allowances. So allowances are basically the coverage you have for a rainy day to cover for bad loans. So when the banks took those high provision charges in Q2 and Q3 of fiscal 2020, ultimately that increases their allowance levels on the balance sheet. Provisions are a hit to the income statement, and then they filter into allowance levels on the balance sheet. When you release provisions, as the banks all did in fiscal 2021, your allowance levels come down because you're forecasting that you don't need that same kind of coverage for potentially bad loans. And so they still have cushion above where their allowance levels were pre-pandemic, both on their retail books and on their non-retail books. So they do have room to move and to release more provisions through fiscal 2021, provided that their forecasting models and the macroeconomic forecasts indicate that that's a prudent thing to do. And so, you might still see some of that filter through their bottom line in their quarterly results. It just won't be to the magnitude that it did in fiscal 2021.
Very interesting. I think it comes back to some of your earlier comments in terms of we think we can all agree a rising interest rate environment and maybe headwinds on mortgage origination growth. It is going to come down to, does that consumer remain strong? And I guess maybe what we see over that consumer over the middle to back half of the year.
Yeah, and the only other thing I'd like to add there, Patrick, is that hopefully we'll see an uptick in loan volumes. So even though interest rates hadn't increased through at least the large banks Q1, if you get an uptick in loan volumes, obviously you're going to get more net interest income.
Right. Very interesting. Well, maybe I'll just take the note because we still have a couple questions to work through, which will maybe be a few minutes. But if there's anyone else out there with another question, maybe get it in, as we'll spend another 5 or 7 minutes addressing these questions before we let you go. I'm going to bounce back to, you talked about those other risks. Digitization was one of them. So question, with respect to digitization, what level of competition or threat do you see from fintechs or other disintermediating financial institutions, especially with the onset of open banking, which will take effect within the coming years?
Yeah, it's an interesting question. I mean, fintechs have been around for a while, but there's still a lot of uncertainty related to this as well. There's a lot of talk about that we need regulation around fintechs and data security and things like that. And on the flip side of the coin, you'll see a lot of the banks partnering with fintechs, right? And so you'll see them doing that to get things to market quicker, to capitalize on some of the things fintechs are doing, investing in fintechs. So I think there's still a bit of a transition there where they're looking to see how and where they can partner with the fintechs. And I think fintechs on their own, the regulators are looking at, how to monitor and you would think regulate the fintechs as well. I mean, data security and things like that become an issue. Open banking can amplify that, right? I mean, from what I've seen in Europe, open banking hasn't had the impact that people initially thought it would. But that's not to say that won't happen in Canada and increase the level of competition, which is what open banking is meant to do. There's still, the Bank of Canada, I think just not long ago released more disclosure on open banking, and they're also working on a payments modernization system. So things are still in development on that, and we're still moving on that. So, what I would say is the big banks realize, and banking in general realizes that, fintechs are here, and they've opened up new ways to engage with consumers. And to tap into consumer preferences and what consumers really want on an engagement level from their platforms. The pandemic has brought forward the digitization by years of where it would have been without the pandemic, and the banks realize this, right? So digitization strategies are top of mind. And as I noted earlier, they're looking to partner with the fintechs where they can, because they know that their clients are looking for these customer experiences, online capabilities, and so on and so forth. So they're looking to see how best to deploy form their digitization strategies and then carry them out. And as I noted earlier, they also need talent for that as well. when they're doing that in-house, right? So, and that talent is obviously a limited supply.
Interesting. And I can't help but think as well, as you reference that, that's obviously a challenge for the incumbents of the large banks. But I guess also, and as we talked about, our ratings universe includes, Equitable and Home Trust, which I guess even in a traditional sense are doing something a little different, and they've grown in recent years, and I guess they're challenging as well. So getting hit from all sides. So this is and I'm going to assume this is a comment based on maybe asset base or book size, but the question relates to Bank of Montreal and BNS, and it is saying, could you see Bank of Montreal becoming the third largest bank in Canada? Again, doesn't specify what metric, but I'm maybe thinking just meaning overall asset size.
Yeah, the most common metric for size of banks is the assets. I mean, BNS is obviously the third, as the question notes. It's a hard question to say, right? I mean, at this point, and the reason I say that is because they all have elevated capital levels, right? So with BMO's acquisition of Bank of the West, it adds a fairly material amount of assets to their US book. It also brings down their capital, right? And so now at the close of that transaction, their capital will be a little bit tight from what we've seen above the 10.5 CET1 threshold, and then forecasted to increase post-close. But the other banks still have elevated capital levels, so they could do acquisitions, right? So it's hard to say whether BMO would overtake them, BNS, because that's also predicated on what BNS does. They are also, as most of you are well aware, they're also in different markets, right? And so, BMO is now expanded well on the west side of the U.S., and they had a very, decent presence with Harris Bank in the U.S. and the Midwest already, where Scotia's, bread and butter outside of Canada is not the U.S. There might be some potential acquisition opportunities that they're looking at as well, and then that changes the asset base.
Interesting, and you may have pre-answered. We'll take this into our last question. It's along the same lines, and effectively asking, the potential for increased acquisition activity by the big six. Do you see that in the Canadian or the U.S. market? And then the second part would be is that, do you expect higher acquisition activity within the smaller and medium-sized banks as well?
That's an interesting question. I think, with acquisition activity, when you're talking large banks, it'll likely be in the U.S. There's not a whole lot in Canada, to be honest, despite the recent transaction of Equitable acquiring Concentra. I think some of the big banks are looking at wealth acquisitions. Some are looking at commercial and retail acquisitions. Some at both. So I think the opportunities based on your question are more in the U.S. Not to say nothing will happen in Canada, but do you expect higher there might be some acquisition activity in the small and medium-sized bank space, but I think it's a little more limited, the Canadian market, to be honest. And so Concentra was an opportunity that came up that won't always come up. They have over 10 billion and I think it was 11 billion in assets. So not insignificant, and so still in that small and medium size bank space. But I think if you try to think about it, those ones don't come up a lot. So hopefully that answers your question.
No, I think that's a good overview in terms of what potentials are out there. Well, I just thank you to the audience for taking the time to join us and participating with the questions to help along this interactive dialogue. We hope that you found the discussion today informative. The presentation will be available shortly for replay on Bright Talk, as well as our DBRS Morningstar YouTube channel in the coming days. If you have any further questions for the analytical team, we have Carl and Maria contact information out here. Please feel to reach out to them directly for any of those questions. Thank you again for your time today, and we hope everyone enjoys the rest of the day.
Thanks very much. Bye-bye.